So today I want to talk more about the VIX, the fear index, the implied volatility on S&P 500 options. Now I have another video out there where I discuss the VIX in general. You can check that out by following this link here. Today I want to talk about whether or not the VIX is in bubble territory, given the fact that I've seen that in the news recently. Now you can check out other videos of mine about other things being in bubble territory or about irrational investors if you follow these links right here. Now, so is the VIX in bubble territory? Let's take a look at the data. So what I've done here is I put realized volatility, so the actual volatility that happened versus the implied volatility from VIX, from the S&P 500 options. And we can see that there is a difference here. If the world was perfect, the markets were perfectly efficient, these things would match. Right in the news, we're saying, hey, right now we're at an 18-point spread between the two, and that puts us in 99.6 percentile range. Let's go ahead and add to this. We have, of course, the realized volatility in blue, the implied volatility in orange. Let's go ahead and add in gray the actual difference there. And we can see if we look carefully on this chart towards the end, we actually see that that difference hits somewhere around 22, 23, which is more than the 18 points I was seeing in the market. So very concerning. Let's go ahead and throw in an average here. So here's the mean difference between the two. And we can see that in general, there is a positive premium to implied volatility that's around 3 to 4. We can then throw in some standard deviation lines. We can see lots of instances where that difference is outside of the one standard deviation events. And we can throw in then two standard deviation lines, and we can see there are in fact times when the difference is more than two standard deviations, including recently, but it looks like we've now kind of pulled back probably since these news stories. We can see that, yes, there does seem to be something going on here. Now, another thing we can look at is, well, what's the percent difference, right, between fair value, which we're going to call the actual realized volatility, and the applied volatility. The news stories are saying that this has hit somewhere between 400 and 500% above fair value. I don't see it in the data here. The most I see is 320. This is weekly data, so maybe I'm missing some data, like daily data point in there, but I don't see it. In fact, I see kind of the average being 140, and we're a little bit above that now. We did see some, recently some stuff much higher than that, but it doesn't seem too crazy. Also, in the context of the bubble videos I mentioned on slide 1, I show some assets, for example, Zoom, that in my opinion is 1,100 to 2,100% above its fair value, which seems much more like a bubble to me. Now, of course, the question is, why is that premium there, the 140% on average premium there? I think the answer is people are just in general fearful about the market. They don't want the market to go down. So what do you do when you have stocks, you don't want the market to go down? Well, one thing you could do is you could get out of stocks and put it into another less risky asset class like fixed income or cash. Now, I do have another video out there that talks about kind of the risk of different asset classes in the context of a time horizon. And you can check that out by following that link right there. Another thing, of course, you could do is you could buy a put. It's essentially you're paying a premium to protect yourself against the downside. Now, that would be an option for you if you're fearful of a market decline. Now, I do have a ton of videos out there in terms of what options are, what the strategies are, how they work. If you want to see them, you can follow these videos right here. Well, another thing you could do is buy VIX. The thing is, VIX tends to rise, right? So if you buy it long, it goes up. That's good for you when the market goes down. So this is a way to protect yourself against a market decline, is to go long VIX. And if people are worried out there, they don't want the market to go down and they're buying this, right? Then what we see is a shift in demand and then a shift in price. So right, demand goes up because people want to protect themselves. The price goes up of the VIX contract, which means the implied volatility, which is calculated based on the price, also goes up. So that's what we're seeing here. People are just fearful in the market. Again, worry and fear, that's what's going on here. And it seems to be that's a consistent pattern that we're always going to see VIX kind of overshooting what realized volatility is because people are a little bit cautious. Thanks so much for listening. I hope you enjoyed that. I'm Brian Kozlowski.